Hello and welcome. I'm John Butler, Investment Director at Southbank Investment Research. Today, I'm joined by Algy Hall, financial journalist and author, most recently, of this book, 4 Ways to Beat the Market, a practical guide to stock screening strategies to help you pick winning shares. I should also say that you should be doubly interested in reading what Algy has to say. He is an award-winning financial journalist, most recently receiving the CFA's Award for Financial Journalist of the Year. So welcome, Algy.
Hi, thanks so much for having me in, John, to talk about the book.
Fantastic. Well, look, I must say I really enjoyed reading it. You've got a very accessible writing style, very matter-of-fact, very to the point, and yet I did feel, nevertheless, that when you went through each of these 4 styles that you're going to mention and discuss today, nevertheless, it felt sufficiently thorough. So you're getting the balance right, in my opinion. Well done.
Great, thank you very much. Thank you. I really wanted to make this a really accessible book because I think one of the things you find out when you've been writing about finance for a long time is the most important ideas are often really quite simple at their heart. And what you need as an investor is just to really have a, thorough understanding of those things that matter. And they're often not very many things which actually, really, really matter to an investment style. But so that's really what I wanted to do with the way I wrote the book, was to lead people into this kind of, deep understanding of the 4 strategies which are outlined, just so that they had a real feel for them and felt comfortable with them. And if they wanted to, were able to, apply and use them.
Right. Well, these 4, these are classic investment styles. They are, arguably they're as old as financial markets themselves are old. And yet what amazes me when I go through the numbers here, when I go through the way you structure your argument in favor of each of these 4 styles, it almost makes you wonder, can it really be that easy? That is, if these are so tried and tested and they work, why isn't it all in the price already?
Yeah, well, I think the first thing to say is no, it's not easy. I think people say about investing, it's one of those things which is simple but not easy. And
Right.
and hopefully I illustrate that in the book, and because I part of what I've tried to do is give examples, and one of the examples is a success and one is a failure, and the failures are meant to show that investing by numbers isn't sufficient. You have to do your research. You have to look at what's actually going on under the bonnet. But but screening for using good ideas is a really good place to start in terms of finding stocks which may deliver. But also, I think the problem with the way a lot of people have tried to apply or do apply empirical evidence that certain styles work is that it's very literal. And I don't think that's very useful for private investors unless you really want to buy a kind of factor ETF or something like that. But things like, if you took something like the price to book ratio, which is a famous ratio that's been used to test value strategies, something like that, you would expect to be competed away because it's just so obvious. It's like, why, anyone can construct a portfolio of low price to book stocks. And then the other interesting thing about price to book, which is I've mentioned that as being an example for a reason, is that these metrics that have been used to test strategies in the past, they often become fairly irrelevant just because of the way things change. And with price to book value doesn't encompass a lot of the value which companies have, the intangible assets.
Right, which dominate the market nowadays, right? The world's really changed. I think at one point last year, before the market sold off quite sharply at one point, I believe intangibles accounted for something like 90% of the value of the S&P 500 index, and that was an all-time high. So what one does need to be a bit flexible here, don't they?
Absolutely. With something like that, that's such an issue and it also, I mentioned intangibles and the issues around it several times in the book, but it's there is this big source of value for companies, which is slightly mysterious in how it works, but as a result of it being slightly mysterious, is completely ignored by the way it's treated in accounts. It's not an asset; it's a cost.
Right.
And that leads to all kinds of strange things going on with book value, with earnings numbers, profits. So it's really interesting at the moment, and I don't know, if there's going to be a solution anytime soon for investors, apart from stay wise to it and choose your metrics carefully.
Well, again, all four of these certainly have their merits. As you've also mentioned, all four of them may each have an Achilles heel that one does need to be on the lookout for. But let's march through them now. So you begin with what, again, sounds so simple, and yet to truly do well requires time and requires research, and that's quality.
Yeah.
Of course we want to buy quality. We want to own quality. The problem is we don't want to overpay for quality.
Yeah.
And so how does one, go about in using the quality screen?
So the quality screen, which is it's actually over the period the book covers, it was the most successful of the lot. I think it produced a 508% total return, and the market was the index that was used, which was screened, was up 120%.
Which is what, the UK FTSE 100?
It was the FTSE All Share.
All Share, sorry.
Yeah. But it's with quality, the screen just goes out. There was an initial incarnation. I had to change it halfway through the period. Initially, it did take account of value. It used a peg ratio, which is one of those ratios which is so simple it shouldn't work, but it can work when combined with quality metrics.
Right.
I think Jim Slater's Zulu principles is a good example of that's what introduced me to the idea. He combines peg with a whole load of quality criteria, and it's effective if you do that. But on its own, it's just measuring what a stock's priced against earnings at plus the growth rate. So that's too little information. It should be too little to give an edge, but with other things it can work. But anyway, the quality screen had to drop that because quality got so expensive. And I was in the situation of looking at the output of the screen saying, well, these aren't quality stocks. There are things like house builders in there. And I use a house builder as an example, which is, you can get, better or worse house builders, but it's incredibly cyclical.
Absolutely.
And incredibly operationally geared. So, when the bust comes, house builders, completely, go to the wall and historically have often gone bust. So I just then focused on quality. It's mainly return on equity, margins, balance sheet, cash conversion. The things which are fairly obvious, I think, to people who kind of get down, start thinking about what quality is. But it worked fantastically. On that basis, and then in terms of trying to explain why this happens in the book, I suppose the main the main argument I've used is what a physicist and kind of data visualization pioneer called Hans Rowling called the straight line instinct, which is that everyone tends to view progress in straight lines,
right?
Whereas
the real world does not work that way.
It doesn't work that way, and also quite. Straight. You can be disappointed about your straight line, or you can be. But also, if you're wrong in another way, the surprise can be delightful. And with good quality investing, the surprise is a delight because you're compounding. And when you compound, you build from a bigger base every year. You're kind of just building your base that you're kind of generating more profit from, and it can go on for a long time. You do get so-called S curves in the market, so it'll tail off in the end. But so it's these amazing companies which are kind of hidden in plain sight. And if you actually are lucky enough, and we all get fooled into think we found quality compounders when we haven't all the time. But if you actually do find one, it's actually surprisingly hard to actually overpay, even when you're dealing with earnings multiples and things which look.
Because it's exponential, because your return should be exponential over time.
Yeah.
Right.
So or you have enough of that exponential journey ahead.
Right.
So this is and then there's a lot of evidence that people have back tested using across loads of different markets, etc., suggesting that certain types of profitability measure are linked with outperformance.
Right.
But the real interest for me in writing the book is why is that? What are these companies? What are their characteristics? How how do we improve our chances of finding them?
Right, right. Well, that in a way that brings us to the sharp contrast, I would say, with the second investing style that you bring up, which is classic contrarian value.
Yeah.
Which is in a way it really is the opposite of going for quality, which is almost like going for what's obvious, as you say. Obviously, you still have to navigate the forest and the trees and whatnot to truly find quality in the right way. I get that. But contrarian value, this is the classic, the stock that no one wants to buy,
Yeah.
the one that's trading at a amazingly low PE, or maybe no PE at all if it's a turnaround target or something like that may nevertheless have some sort of intangible value that's not showing up in current profit, but maybe it has brand recognition, maybe it has something to still recommend it. And so I like the contrast between those two right from the get-go. And isn't the holy grail to notice when the market is beginning to overpay for quality, however rare that might be, and seeing the opportunity to get into contrarian value instead?
Well, oh god, yeah. If you could do that, if only, I think probably. I mean, now those factor investors, they do try and do style timing and stuff.
Yep.
But I think for most of us, it's kind of this style timing is kind of gets very dangerous because it's you're always tempted to move at the wrong time essentially,
right.
And then if there's that other really hard psychological thing when you get out of something, and you've done it successfully, it almost becomes harder to get into something again because you want the timing to be almost perfect. And and timing's very rarely perfect in investing. But it's a great point you make, because the quality is when you can see it in front of you, and you're buying what you can see. Whereas value is kind of when you see what you see is disaster.
Right, right, exactly.
And it's like steel yourself. And I mean, I kind of I do think, contrarians have to have that article of faith in their makeup that, things revert to mean. It's about mean reversion. Things are really bad now, but they weren't as bad in the past. And psychologically we know, people, see a situation as it is now rather than being able to imagine something which is very different in the future. So things do get undervalued. And the contrarian investor is saying they're undervalued, but they're going to get that bit better, which is going to make me my turn. I mean, but obviously we've lived through a period of disruption, so we're very aware probably that sometimes things get worse, and reversion to the mean is actually the mean is bankruptcy for a company now rather than what it was in the past.
I mean, this is why even a contrarian is never going to put their eggs in one basket. The whole mentality is that you're taking an obvious risk.
Yeah.
With quality, you don't know you're taking an obvious risk because it's not obvious.
Yeah.
But with contrarian value, you sort of know you're taking an obvious risk. And this is why I believe if you look at the simple maths of diversification, and let's assume for the moment that all shares are uncorrelated with other shares, which of course isn't true, but you need to get up to at least high single digits to begin to approach what becomes an eventual maximization of diversification benefits, more or less. That is, you only begin to get sort of at that level. So I would assume that when you are applying a contrarian style, you're looking for at least a decent number of candidates, such that if one share just doesn't pan out, company never turns itself around, it ends up in reorganization or who knows what it might be, your other ones have every chance to succeed in the meantime.
Yeah. I mean, it's totally high risk. I mean, they're two high risk styles in the book. This is one of them, and I go through the drawdown the screens have experienced when I'm kind of just talking to the performance numbers, and this is kind of to say to people you actually don't want to just do a follow the numbers off the shelf portfolio kind of take on these screens, because how are you going to hang on when during the maximum pain point. And during the pandemic market crash, I think the contrarian value screen did a peak to trough fall of over 50%.
Wow.
So it's like really, I mean, it's like you wouldn't, if you had just invested on the numbers and were holding these shares, and you suddenly see your net wealth, more than half. I mean, you're not going, just try keeping faith with that. Whereas if you selected a good diversified number of stocks which you really understand, then you're gonna understand what's going on with your portfolio
Right.
that much more, and you've got that fortitude, hopefully, to kind of make sensible decisions.
Well, in the same way that I just described, you want to have a certain minimum number of holdings to even begin
Yes, yeah,
to maximize the possible diversification
absolutely.
benefits. You could also say that you do want to diversify across these styles. You mentioned a moment ago trying to precisely time when you get out of quality and into value, or anything else for that matter, is kind of a risky game. So why not diversify your style by always having at least some allocation to each? And you mentioned that there's one other amongst the four, other than contrarian value, which is also relatively high risk. Would you like to elaborate on that one?
Yes, yes, that's momentum
Right.
investing. I mean, I'd say in terms of diversifying, you could. I mean, you could try that, but also I think some of these strategies people tend to. I don't know if you find this with investors you come across. They tend to just gravitate towards certain styles.
Right.
So something will just really resonate with them, and then and they're a value investor or they're a quality investor or whatever it may be, and that's and I kind of think using that to your advantage, so that you stay consistent with what you're doing, is probably for most people the kind of good advice.
Right.
But I think some people may fall into several camps and be able to do that also. And ideally, you would be able to balance out your portfolio along the.
Well, I know one very successful UK-based value-oriented manager who nevertheless forces himself as part of his investment process to allocate roughly, he rebalances regularly, but roughly 20% of his portfolio just to following momentum. And he says, when he explains it to me, he says, look, I'm all about value. In the long term, value is always going to win out, in my opinion. That's his view, that's his belief, that's his faith. But he then interjects, but it's actually very helpful to know that a certain portion of my portfolio is just running itself. No real stock picking involved at all. Pure algorithm. And what I find when I combine these two styles, 20% to 80%, I have consistently smoother results and roughly the same overall returns over time. And he swears by blending those two styles.
No, it's really interesting. I mean, also those two styles. I mean, they're both high risk, but they're actually pretty good bedfellows in terms of when they tend to do better.
Bingo. That's the way he explains it. He believes they truly diversify and complement each other.
Yeah, no, it's very. So yeah, no, I could see that. I mean, with the momentum strategy in the book, is working off the classic price momentum,
Right.
and then also it's adding in a degree of fundamentals, because it's looking at companies which have strong forecasts for earnings growth, but also achieving very regular and significant earnings upgrades. So it's kind of the crowd is chasing the share price, but also the brokers are struggling to keep up. So there's good news which keeps on arriving, and they can be a lot of different reasons for those kind of good news stories to carry on unfolding. But often it's very hard for brokers to actually adjust their forecast
Right.
based on a trend continuing, because you can never say when it's going to stop, even though you can understand how it will continue. You can't, it's very hard to.
And sadly, when trends do reverse, it's more often than not asymmetric, and you give up a lot in a very short period of time.
Yeah, absolutely, and that's kind of like the big danger with momentum strategies. Right. Whipsaw reversal. I just the phrase I've always used, but I mean, and part of the reason to pair price momentum with momentum in fundamentals is that slightly lessen the chances of just chasing complete hot air, because I think end of 21 we saw some of those amazing story stocks come completely explode in really rapid amounts of time. But I mean, the screen in the book, it didn't avoid that.
Right.
I talk about this in the book, because it got on the back of companies which had seen their earnings inflated by the circumstances of lockdown.
Mm-hmm.
And brokers, they just carry on, but it's all got to carry on being good until it's not.
Right.
And so it got whacked then really badly. But But yeah, but I think, hopefully, the fact that a company has to have earnings, and it has to have earnings which are, you know, they're of a meaningful amount, kind of thing. That hopefully protects a little bit.
You would assume that if there was a general loss of earnings momentum, that there's no way the price momentum in the stock would have just kept on going too much longer. It's like the coyote running off the cliff, chasing the roadrunner or something like that, right? And all of a sudden, finally, it's going to fall to earth.
Yeah. The inevitable is there.
Fantastic. Well, look, we've left out one of your 4 styles.
Oh yes.
So who have we missed, or what?
So I guess in terms of if you're a factor investor, it is low volatility or low beta, or bet against beta. I think it's sometimes called in investing. So it's this weird phenomenon that rather than the market doing what people logically would expect, or in what efficient market hypothesis suggested does, which is reward people for taking more risk.
Right.
In actual fact, when you look at what actually happens, you get rewarded for taking less risk.
Free lunch.
Well, yeah, it is. I mean, it is something. It is one of those things. Except, as is always the case, it's not entirely free, because you outperform in one of the least interesting ways possible. Because you do well when the market's doing badly, and you do badly, but less badly than the market.
Right.
Great sales pitch. And when the market's really hot during those recovery phases, when value's shooting the lights out, for example,
you can still participate.
But you don't participate as much. You're
much
behind
though.
the market.
Right.
You'll carry on probably, but it won't. Your friend who's a value investor or whatever will be saying to you, "Oh wow, what a day I had," and you're like, "Well, my day was really dull." And then also during kind of growth markets when momentum is doing its thing,
you're also
again you'll just be having really fairly dull performance.
But the idea is that you're smoothing out your returns to some extent, and you're saying that you're actually compensated for smoothing out your returns, such that you could argue you could be slightly overinvested. That is, because there's less implied leverage in that investing style in the first place.
You could play it like that. So I mean, as much as that, it depends on who you are and whether you're in a position to take on leverage, or whether it's advisable for you to take on leverage. Because I think for most private investors, leverage is just like probably something that won't work for them, and that can get them into trouble, because also as soon as you start doing it, it's kind of it's a bit like an addictive drug. It's kind of worked, and so
I throw the word out there. I throw the word leverage out there. It could simply mean implicit leverage. That is, instead of being 50-50 stocks bonds, you go to 60-40 stocks bonds, but apply this relatively less volatile style to the stock portion of the portfolio.
No. You can, absolutely. Because I mean, it's more sleep well at night. And so,
exactly.
I mean,
exactly.
If that's what you, it's going to help you do that. And but I suppose in the book, one of the things which really interests me about low volatility is that that just a question of so what does that tell us about the companies? It's kind of like, this is a feature of so, but actually what's it telling us? And the screen in the book pushes into the idea that these are conservatively managed companies.
Right.
And when a company is conservatively managed, they're far more averse to investing their capital in new growth projects, and they're far more likely to be returning it to shareholders as cash, because they when they're making their capital allocation decisions, they just think this is more prudent. We're a conservative management team. We don't want to take risks with this. So the screen pairs this idea of low volatility through beta with strong dividend records, and then in other kind of balance sheet tests and a few things like that. And then it also asks for a decent dividend yield, because I mean there's no dividends are a zero sum game, because it's just they get paid out, the stock falls by the same amount. It's kind of so it's all about, really, in the book what it's telling you about the company. And if the dividend yield's attractive, or this is the logic behind the screen, it means the stock's being overlooked. So it is conservatively managed and dull, and these are the kind of stocks which will actually deliver the kind of performance that you want from a low volatility strategy.
Well, look, if we're talking about a world of rising interest rates where there's actually an opportunity cost now, where if you're not getting the dividend, you might have to wait a long time to realize intangible value some years into the future. But in the meantime, your cost of capital's gone up. Interest rates have been rising. I would expect this sort of style to have re-rated and started to do somewhat better as a result of being in this rising rate environment.
Yeah, I think when you look at low volatility in the very simple way, factor investors measure it, it has started to enjoy some time in the sun again, whereas it was doing terribly before. There was a real that's the thing when you look at the when you look at the empirical research. It goes everything. They all go through periods. Their performance is built over a very long periods of time,
right? And
they go through periods when they do, terribly, and then periods when they kind of like finally realize.
Well, now I'm going to put you on the spot because you've said now on a couple of occasions that it's really a difficult timing game to try and move abruptly between one style and another style to try and realize the highest possible returns at any point in time, but. If you did need to choose one of your four styles, or the four styles presented here, if you did have to choose one right now, which would it be and why?
So I'm going to answer this in a very kind of weaselly way, if you like, because it kind of depends on where you think we are, I suppose. And that so if you think we're going to have a recovery, and if you think actually interest rates have peaked, inflation's coming down, the growth numbers are holding up better than a lot of people expected. And so we're going to move into recovery. You'd go for value, because value, when markets come back, value does spectacularly well. And we haven't had the kind of abrupt crash we had in 2020. But after that, the value screen in this book just had such an amazing time. It was unbelievable. It was kind of, I was putting the performance figures a year later and just like unable to believe what had happened to these stocks. So but then if you're in the in a more gloomy mood set, shall we say, probably the low volatility dividend screen is where you'd be, because those kind of stocks which have long dividend records often also have pricing power.
Right.
And it may not be the obvious kind of pricing power that massive shining gross margins,
but just
stable
stable
companies have. But yeah, exactly, an ability to hold their market position and hold prices within it, and then being conservatively managed. They're prepared for, tough economic times. But then I suppose quality is also worth mentioning, because that's where you really do have pricing power. It's like, you're selling something which, we know which people desperately want, which is why you have high margins and high returns on capital. But the problem with quality is that it got so expensive during the last cycle and so popular. And a lot of that's kind of unwound. But I'm not sure quite how much is unwound of it. So I think that's that it was very much it was the last market's game was quality, and that you always have to be a bit cautious, I think, about continuing to play the same game.
Right.
Maybe a way. There's no way of knowing, but there's just a degree of caution with that one, I'd say.
Well, look, the fact that all four have long proven track records means that you can hardly go wrong by at least considering an allocation to any or all of the above, and there's no need to get too cute about choosing a given style at a given amount in time. And indeed, it could be a disadvantage and a distraction to be too active with something which, let's face it, is a more medium-term oriented investment approach anyway. Well, look, that's a nice whirlwind tour of the book that you've given us of the four styles. Anything else you'd like to add about the book? Anything else that you absolutely think our viewers would want to hear?
Oh my goodness. I suppose one thing I would say is that when I wrote it, the idea is that it's kind of practical. It's something that people it's practical for engaging with these really important ideas in investing, and also in how to apply them. And it runs through accounts and financial ratios, as well as kind of putting it all into a package, which means you can hopefully identify really interesting stocks, and then goes on to just the ways you can apply that in terms of your actual research. So I suppose if I get one more plug, and thank you very much, That would be it. It's come, it's come by, hopefully you'll, from reading the book, people come away and they'll actually feel like they've learned something valuable that if they want to apply, they can apply.
Oh, it's very accessible. You make things very clear, and again, it does get a little bit, numerate and slightly complex at times. But I felt that when it did, it was unavoidable. It just needed to be done. So thank you very much for your time. I've really enjoyed our chat. I very much did enjoy the book. Once again, 4 Ways to Beat the Market by Algy Hall. Thank you for watching. And once again, I'm John Butler, Investment Director at Southbank Investment Research.